Find out.
See what happens.
I mean, yes. I know exactly what's going on. Completely in control.
Yep. We're in good hands.
Yes. You can trust me. We live? We are? No? Oof, anticipation. All right. Call this special meeting to order. First order of business is to adopt the agenda. Can I please get a note or a motion to adopt the agenda, please? Councillor Gill. All in favor? Carried. That brings us to our one and only item, item 3A, the audited financial statements of 2025 and the audit findings. Robbie, please take it away.
Good evening, Mayor and Council. Tonight's presentation is on the 2025 audited financial statements. At this time, I would like to invite Mr. Jeff Alliston, partner with the Metrics Group, the town's appointed auditors, to present the audit findings report along with the 2025 audited financial statements.
What am I going to do? Do I got to click here? Or? Okay. All right. That'll work. All right. Thanks for having me. Got some new faces for this year. So, does Councilor McFadden know she's missing me, or? I'm just kidding.
She's not coming.
Anyways, so thanks for having me here tonight to present our audit findings for the 2025 fiscal year for the town. So usually to begin these presentations, I like to give a bit of an overview of the audit, so why we have an audit and the importance of it. And really it's to enhance the degree of confidence of the intended users of those financial statements. So the main users being yourselves as councillors, ratepayers, municipal affairs, the province of Alberta, so those organizations or individuals with a vested interest in the financial performance of the town. As auditors, we're looking to assess if the financial statements present fairly in all material respects in accordance with Canadian public sector accounting standards. So those are the accounting standards that your municipality reports under, as well as all other government organizations. As independent auditors, separate from management, so we design procedures to provide reasonable assurance, which is a high level of confidence, but it's not an absolute guarantee. After the conclusion of our audit work, we then issue an outcome or our opinion on the financial statements. When it comes to our responsibilities, just to note management. So management designs the processes that ensure transactions are recorded accurately and that the year-end numbers of the town reflect the true position. When it comes to those charged with governance, just to note that the ultimate responsibility of the financial statements lies with council. And then our responsibility as auditors is to obtain reasonable assurance that the financial statements are free from material misstatements. We exercise professional judgment, maintain professional skepticism throughout, and then issue our opinion on the financial statements. When it comes to our audit results, in order to finalize our audit as of today's date, we'll complete our standard completion procedures, such as subsequent event work, our communication, which is what we're doing here right now, and then approval of the financial statements from council. After that, we'll be able to issue signed audited financial statements. When it comes to your accounting policies and estimates, we feel that your estimates and policies are in line with the accounting standards, as well as best information available when it comes to the estimates. Procedural results, we do have a revenue balance restatement in relation to your developer levy revenue recognition there in the financial statements, as well as additional other finding. And then at the end, our opinion on the financial statement is that they present fairly in all mature respects in accordance with Canadian public sector accounting standards. When it comes to significant audit risks, so these are areas of concern or focus for us while completing our work. So you'll see on the right-hand side, results of our testing. We have no significant findings noted in any of these areas. However, we do have an item issued with other matters in relation to tangible capital assets, which is really in relation to construction in progress and the disposal of assets that are within that category. When it comes to financial results, I'll just go over some brief highlights for the year, some items to be noted. So this is your statement of financial position or snapshot of where you were at as at December 31, 2025. You'll see the blue item in the middle there, your net financial asset position. So if you would take your total financial assets, cash, investments, collect your receivables, look at your liabilities, it knows that you have sufficient financial assets right now to meet your liabilities, so pay all your debts there and still be in a $46 million positive position. When it comes to your financial assets, mainly comprised of cash and investments, so that makes up about 85% of your total financial asset position, with the remainder of trade receivables making up the additional balance there. When it comes to changes in your cash position, you would have started the year at $43 million. You'll note you have an annual surplus of $25 million, which we'll talk about later. You add back amortization as well as your change in deferred revenue, increases your cash position. You took on some new debt, about $10.8 million, spent $45 million on tangible capital asset additions, purchase some additional investments, and decrease your cash position down to $20 million. So that's kind of showing you where your money came in and then where your money went out. When it comes to receivables in relation to taxes, you got about $1.4 million in arrears taxes. So that's anything that's 1 year or older. Current taxes of $324,000. You'll note there's no allowance set up for any of these, as you have sufficient assessment values in order to recover the current tax position that's outstanding. Other receivables for the town, looking at your trade and other, about $16.8 million. So the bulk of this is made up of development receivables, so about $13 million, $2.2 million in water and sewer. When it comes to receivables from other governments, this is grant programs, in essence, that you have spent money on for projects or in relation to collection or been approved for the funding. So local government fiscal framework of $4.1 million, and then your Canada Community Building Fund about $2 million to make up the bulk there. When it comes to the investments of the town, so you have two investments here. You have what's called a principal protected note, which is measured at fair value. So these investments track in relation to the market's performance. So they are protected in the sense of if they were to be sold at maturity and they're in a loss position, you would still retain your principal capital there. However, if they are positive and then are sold, you would have a gain on those investments, in which case that gain would then come into your statement of operations. Currently, the position of those is tracked in what's called a remeasurement gain loss, which is included in your accumulated surplus, so there is no recognition of that in your operations, but that would tell you if they're either positive or negative in relation to that schedule. Investments measured at amortized costs, mainly made up of bonds, so interest rates on those, ranging from about 3.9 to 4.2% on those products, which make up the bulk there of your amortizing cost investments as well as GICs. When it comes to the liabilities of the town here, so the bulk of that really tied up in deferred revenue here of $66 million, as well as long-term debt of $51. So when it comes to your deferred revenue, you'll see in here you've got grants as well as developer levy funds that have been collected by the town, but is still to be provided or allocated towards a capital project in the future. So $26 million in new additions there. $7.3 million was spent, mainly in relation to James Walker Trail Stage 3. You also had wastewater piping or twinning there, so that's where the developer funds went. When it comes to grants, your local government fiscal framework, Canada Community Building Fund 2025 allocations, and then projects in relation to those, mainly with MSI funding, Glen Patrick Drive, and then Glenbrook Crescent infrastructure. So those were some projects that used the levies as well as the grants in the year. So about $14 million coming out and $66 million in deferred revenue going forward. When it comes to the debt of the town, so you have debt limits in accordance with the Municipal Government Act. So your total debt limit is 1.5 times your total operating revenue, so about 150 million. You currently have 56 million in debentures, so you have 94 million in unused debt. And then your service on your debt is your total principal plus interest to be paid in the upcoming year. So the allocation of that is 0.25 times your total operating revenue, or 25 million. Your next year's expected debt repayment is about 55 million in principal and interest, so about 19 million left of unused there. In looking at your non-financial assets, so your tangible capital assets, you'll see you got $56 million of new assets that are added to the municipality. So whether additions that you would have paid for, about 46 million, there's about 10 million of contributed assets, so about 56 million in total. Such projects that I mentioned before with the grant projects, as well as the RH pump station and reservoir, Horse Creek Sports Park servicing, to name a couple additional ones. So from an audit standpoint, we're looking at what was approved in the budget for capital projects, what the actual ones are, but we're also looking at how these projects are being funded, so whether through levies, grants, reserves, taxation, to make sure those are all in line with expectations there. When it comes to amortization, so 15.7 million, this represents the usage of the town's assets in the year. So when you have graders, roads, other infrastructure that lasts, say, 5 years, 20 years, 40, 50 years, you take a percentage of those assets and they represent the amortization that gets reflected in your operations. So you'll see that you're definitely adding to your asset pool. So again, replacing and adding new infrastructure in relation to the amortization expense of 15 million there. So if you were to take your net financial asset position plus non-financial assets, you get what's called your accumulated surplus, which is about 647 million. A large portion of that is your equity and tangible capital assets. So that's how much of that amount is tied up in your TCA, so 542 million. You'll see the increase in that year over year is about 36.4. So that means that you've definitely added quite a bit of additional money in relation to your tangible capital assets, whereas the net change in your unrestricted and capital and operating reserves is 11.3 to the net downside there. In looking at the statement of operations for the town, you'll see your total revenues at 93.3 million versus 85, so about an $8 million increase. When you look at taxation, that was about 2.84 in relation to assessment value increases. You saw an increase in your sales and utility charges in relation to rates and consumption in the year, so that's what drove the sales and user charges increases. Other items to note in there, licenses and permits, you saw increases in business permits in the year, and as well as other revenue where you had FortisAlberta streetlight power revenue coming in from that in relation to streetlights, so that was the difference in the other. So again, about an $8 million or a $4.6 million change from budget. In looking at your budget to actual, this chart here shows you what your actuals are in the bar, and then the line graph represents what you had budgeted for. So all items here are relatively more than what was expected, except in relation to your investment income. When it comes to expenses by function, or by department, you'll see your utility services, those were up year over year. You had additional amortization costs in there, so assets that were coming on stream and amortization taken, causing the increase there, as well as additional wages. Community services, additional wages and consulting costs in relation to that category. And then same with general government services with additional wage costs there. So about 5.2 million. And then we look at the budget, it's about 10.6 million over there, but your amortization expense is about 15 million, which is an unbudgeted item. So when looking at the expenses by object, so what was the money spent on? Again, wages, salaries, wages, and benefits. So increase in your FTE there, 32.6 versus 30 in the prior year. Contract and general services are up as well, as 17 from 15. And then you can see the amortization expense there, 15.9, which is an unbudgeted item there. So again, looking at this, all items were pretty much at or below the budget. The next item here is your other income and expenses. So contributed assets, so 10.3 million. You saw assets from Fireside Phase 11B, Riversong Phase, as well as Heartland Phase. So additional developments, in which case you take over ownership of those assets and the maintenance of those going forward. Offsite levy revenue, 6.9 million, again in relation to capital projects in the year. And then government transfer capital, which is the grants used for additional TCA as well. So if we look at everything in whole, your total revenues were 93.3, expenses of 89, other income of 20 million, leaves you with an annual surplus of 25 million. Now with that said, when I spoke earlier on the accumulated surplus side, you have a 36.4 million increase in your tangible capital assets and $11 million decrease in your net of your reserves and unrestricted. So although you have a $25 million increase, all that was really going into increasing your tangible capital asset amount there through either grants, levies, those type of items to cause that to increase versus increasing your cash or reserve position. So in summary, we're giving a clean opinion on the financial statements. I have a finding letter that I'll jump into as well after this. Your net financial asset position is still positive at 46 million, so sufficient financial assets to meet your liabilities. And then an annual surplus in the year of 25 million. Do you have my other? This thing? Oh yeah, perfect. Okay. This is our my other part of my presentation. So this is kind of the qualitative side of things where we kind of go over our findings in relation to the work that we had done. So to begin this one, you can scroll down or I guess I can do it. There we go. Okay. So begin this, just a brief executive summary. So I spoke earlier, in order to finalize our audit, we got to complete a few more items. When it comes to changes from our audit plan, our only real change is in relation to materiality. So we always set it based on prior year actuals and then adjust in accordance with current year actual results. So we use 4% of operating expenses, so roughly 3.5 million. So what we're saying here is if your revenues or expenses, say, were to increase or decrease by that amount, we feel that a user may have a different view or outlook on the financial performance of the town. A trivial threshold is in relation to if we note errors kind of below that amount, they don't end up on our schedule, and that's set at about 1% of our materiality. When it comes to significant difficulties, we did not encounter any significant difficulties that should be brought to the attention of the council. When it comes to our engagement team, myself and Dale were the main contacts who are responsible for the services our firm performed in relation to your audit. When it comes to audit results, so these are areas of risk or key concern for us. So the first one being management override of control. So management is in a unique position to potentially perpetrate or manipulate the financial statements. So whether due to fraud or error, so say trying to adjust amounts to conform to budget, increase annual surplus. So we use data analytic tools that identify journal entries that may be indicative of that. So we're looking for entries, say, that are posted outside of work hours, odd or unique number sequences. So we're looking for anything that's unusual to be picked up and then testing those. So we had no significant findings in that area. When it comes to revenue recognition, we want to make sure that revenue that has restrictions or well as service requirements, that's being recognized once those are being performed. So we had no significant findings in that area. When it comes to operating expenses, as well as salaries, wages, and benefits, we want to make sure that transactions are in the correct fiscal period. We want to make sure that employees are being paid the correct amount. We want to make sure that employees exist. So we had no significant findings in those areas. Cash and investments, we want to confirm balances there directly with the banks, and then also in relation to your investments, making sure those are being calculated correctly. So fair value adjustment for the principal protected notes, as well as your bond premium and discounts. We had no findings there. And receivable balances. So is deemed collectability meant to be there? Should there be an allowance? So another key risk or concern for us when performing our work. And then the last item here is tangible capital assets. So here we want to make sure that items that meet the definition of a tangible capital asset have been capitalized, your amortization rates are correctly calculated, any gain loss. And then also as well, looking at your budget. So what was the budget approved by council in relation to TCA projects? Were those the ones that were being done? And then how are those being funded? So a lot of work ties back into the capital asset additions. So we do have another matter in relation to that further on in our report. When it comes to our control environment, we have no significant control deficiencies to note to council. When it comes to your accounting policies, we feel those are in line. When it comes to your estimates, so estimates such as an allowance for doubtful accounts, useful life and tangible capital assets, your asset retirement obligations, those I think are best based on best estimates and are been calculated and reflected correctly in the financial statements. When it comes to other matters, we have one here in relation to work in progress. So we had just noted while completing work in that area, we had a significant amount of work in progress that we were expensing in the year as a gain loss on disposal. So, you know, work in progress, or when it goes into capital in accordance with the accounting policies, it's meant to be capital. We've seen that projects are kind of just being tracked or put in there. And then if they go forward or not, then they're continued on, and if not, they get taken out. So we would rather see them being expensed in the year, and if there is a capital project, then move into capital versus tracking it in there. So it's kind of overstating your assets by $600,000 when you're not, when they don't actually meet the definition of being a capital project. So that's where that comment is coming from. We have a management letter that we'll issue to management in May, but if council wants to see that, that will definitely be available. But sometimes we do note non-significant items and tend to advise management of those as well while performing our work. When it comes to misstatements, so these are items that we would have noted while performing our work. So we have some adjustments in the year. So it's 3 audit adjustments versus 8 in the prior year. The net impact of that is $48,000, and then we also have additional adjustments in between accumulated surplus and annual surplus that are changed there. So our net impact was about almost $13 million in relation to that, and that part really represents the internal accounting and how things are being tracked between some accounts. So sometimes, not sometimes, but items will be tracked with reserve transfers. And then when we're performing the statements, we have accounts that are ending up on your statement of operations. So we're kind of having to more or less reallocate between some stuff for presentation purposes. And that's just the net impact of that. So we definitely have talked with management, and I think we're going to generate a few accounts there to help us transition that a bit better going forward. When it comes to unrecorded misstatements, we have 422,000 here of unrecorded misstatements. So these are items that are noted while doing our work, but are not reflected within the financial statements. There's a few of them here to record a write-off of an accrual for recovery of wastewater incident, construction in progress. So we had spoke of that issue. That's the 609,000 here. So it's being expensed this year, but should have been expensed in the year that the cost incurred, so a different year. And then to record active transportation fund grant revenue in the correct period. So again, these are more of timing issues. So maybe some that should have been reflected in the prior year that's in this year. So it's kind of just being corrected. When we talked about materiality previously being about $3 million, we don't feel that a $422,000 adjustment to your statement is going to change anyone's view or outlook on the performance. So that's kind of where materiality and these unrecorded kind of adjustments come. And it's pretty common to have, you know, some of these within an organization your size, really just cleaning up, and some of it has to do with just some timing. When it comes to the restatement, so this had to do with developer funding. So we had just noted that revenue was recognized or wasn't recognized in relation to a developer funding. So it has to do with transportation and water. So transportation developer levies are included in your deferred revenue. So because that funding was used, you saw a decrease there, and then revenue coming in order to fund that project. Whereas it was previously used from water, which is in a net deficit position in your accumulated surplus. And what that means is that you have front-ended projects, and as developer money comes in relation to those, you can recognize the revenue to offset the deficit that you do have in those reserves, whereas the other one, you have the money to recognize the revenue. So it's more of an allocation between the two, but it did change the presentation of the statements in that year. When it comes to the appendices, just a required communication here. So our independence, we do not hold a financial position, have a personal or business relationship or economic dependence on the town. Our management representation letter here, which will get management to sign, just that they were forthcoming with information. And then our last one is Appendix 3, which is new and revised accounting standards. So there are accounting standard changes coming for December 31, 2027. So you'll see the statements change or the presentation. So currently your non-financial assets are at the bottom of your statement of financial position. Those will move up. You'll have financial assets plus non-financial assets will equal total assets. You'll then have financial liabilities, non-financial liabilities, and net assets. So the three of those will in turn add up to agree to your total assets, so more of a traditional balance sheet approach or how it used to present back in the day. You'll also have additional commentary with your budget that'll impact your financial statements and how that's presented, and then a few other additional schedules consistent with your statement of operations and your net assets. So, and I think at the end is Robbie's turn here to talk about this, but I'll be here for questions after. Yeah.
Thank you, Jeff. The recommended action for this evening is that council receive the 2025 audit findings report for information, acknowledging the results and recommendations presented by the external auditors, and that council approve the Town of Cochrane's 2025 audited consolidated financial statements as presented. We will now open up for any questions.
Councilor, can I get a motion? Councilor Gale?
On? Is it working? I'll move.
Is it two motions? Start with the first one?
So do I need two separate or just one?
One, or two, but
Okay.
one to start.
So I'll move that council receive the 2025 audit findings report for information, acknowledging the results and recommendations presented by the external auditors, and that council approve the Town of Cochrane's 2025 audit consolidated financial statements as presented.
Okay, sorry, so it's actually gonna be two motions, one at a time.
Yeah. Okay.
So the first one, the council received the 2025 audit findings as information. Council, any conversation on that one? Questions? Nope. I'll call the question. All in favor on the first motion? Okay, carried. And then can you please move the second motion?
I'll move that council approve the Town of Cochrane's 2025 audited consolidated financial statements as presented.
Any conversation on that one? Councilor Federico?
I did have a question on the capital projects that you kind of pointed out about the funding issue with them being put into the CIP. Is that because I have noticed that, you know, if we haven't started a project, sometimes there's a carryover, it remains in the budget for a period of time. Is that kind of what you're referring to, even if that project hasn't quite started?
Well, we just, ours is more, right, so if you're gonna start a project, you incur some additional costs, it's being capitalized already. But we don't, in our opinion, hasn't meet the definition of a tangible capital asset yet, because you haven't actually, you know, started the project, you're in the preliminary stages, you don't know if you're gonna go through with it, but those are kind of being included in your tangible capital assets. So we recommend that those be expensed, and then once that, you know, project gets going or you're confirmed and you're doing all that, then you can just reallocate and record what should be intangible capital assets. So it's kind of more being used for tracking as opposed to actual tangible capital assets. So yeah, that was kind of our comment in relation to that.
Okay, thank you.
And I had a question. Can you clarify? There was this. I guess you're in a different presentation now, but there was a slide where you showed almost a $13 million surplus, which is quite different from what we would have reported as our surplus. Can you explain exactly what that surplus was and how that would appear differently in our audited financial statements as opposed to our actual budgetary surplus?
Do you mean the $25 million surplus that you have, or the change in accumulated surplus that I was
Both.
referring
There's
to?
so many numbers and, yeah. There was just a very large surplus, partway through your first presentation. And it's very different from what we would see for our budgeted surplus. And I was wondering if you could explain that to me
Actually,
exactly
do you
what
have
that
the
is.
25? Yeah, hold on. This one here. I think that's the annual surplus you were talking about. I'm not sure what your budgeted surplus was, but. The slide?
I don't know if that's the one.
So your budgeted surplus on the statement is 10.6 million, and then your actuals are 25. If you look at note 23 of your financial statements, actually, it shows how we work our way back to your budget of 0, and then how you kind of end up with an actual deficit in the year, about 5 million. Is that right? What do you?
No, and I don't have the.
Oh,
I
you're
don't,
gonna bring up statements? Okay.
here, I'm gonna scroll through and see if I can pull up what I was looking at. I should have noted the page number.
No, all good. Oh, I don't know if the mayor's looking at this. You said 13, are you talking about the developer deficit maybe?
I just thought I saw I thought you were talking about at one point about a surplus that was well over 10 million.
Well, so your accumulated surplus, let's see if I can. No,
And
that's the annual surplus, but yeah, so you have a $25 million annual surplus that's being presented on your statements. But if you were to look here, like your unrestricted and restricted, you'll see you started the year with your unrestricted at 50.4 million near the top there, but the bottom it's at 33.9. So your unrestricted is decreasing year over year. So a lot of the 25 million, or all of it, plus amount from your unrestricted, is actually going into your capital assets, is what I was referring to. So you have a lot of TCA purchases, those don't get expensed, they get capitalized, and then also contributed assets. So that's kind of where I was getting at with those comments. Although you have a $25 million surplus in accordance with the accounting standards, all of that is going into increasing your tangible capital assets for the year, not that you have $25 million more going into your unrestricted or restricted reserves for future spending.
okay, that clears it up for me. It's because it's the capital assets.
Yeah,
And it's the accounting of that. Okay, that makes sense to me.
so that's what's causing that.
Yep.
Yeah.
Thanks. Did anybody else have a question, Councilor Federico?
Yeah, just one more quick question. Will you be restating the audit at all? I know 2024 was restated, or are you just?
No, so in the 2025, we just restate the comparatives within this statement, but yeah, we don't reissue.
You're not
the
restating.
25. No.
All right, well, I don't see any other questions. Glad to see that the audit is looking good. All in favor of the motion as presented? Okay, carried. Thank you.
Awesome, thank you.
And
Yeah.
that concludes our special council meeting. Boink.